Lithium prices are up 122% compared to a year ago, and the sector still feels like a crisis. That tension is worth sitting with. Because both of those facts are true simultaneously, and they point in opposite directions depending on which time frame a portfolio manager is using. The near-term picture is genuinely difficult. Lithium carbonate in China touched 150,000 yuan per ton, the lowest in a month. BYD, the dominant Chinese EV manufacturer, reported a 40% annual sales decline in February. Battery production forecasts were cut in January. These are not noise signals. They represent real demand softness at the exact moment legacy supply projects are still coming online from approvals made years ago. But zoom out 12 months, and the same commodity is up 122%. The market is recovering from a deeper trough than most casual observers remember. The question is not whether lithium is cheap or expensive right now. The question is whether the projects being built or restarted today will be producing at the moment demand re-accelerates, or whether they arrive too early, into a surplus, or too late, missing the window entirely. That timing problem is the single most important variable in this sector right now, and it is not being discussed clearly. 3 things happened in quick succession that changed the near-term calculus for Australian Lithium. Core Lithium awarded a $50 million surface mining contract to NRW Holdings for the Finniss operation, 88 kilometers south of Darwin. Open-pit mining restarts as early as May 2026. All processing follows in the September quarter. First spodumene concentrate is expected to ship in the December 2026 quarter. The company also secured $120 million United States dollars from Glencore Australia and Infravia, alongside a planned $120 million capital raising. Core Lithium shares jumped 13.5% on the announcement. Meanwhile, Global Lithium Resources drew a buy initiation from Shaw & Partners, with a price target of $1.50, against a current price of 50 cents. The Manna project, 110 kilometers east of Kalgoorlie, has a completed definitive feasibility study. Build cost is estimated at $439.1 million. The project carries a 3.5-year payback period, a 14.3-year mine life, and a life-of-mine cash flow estimate of $1.15 billion. The mineral resource sits at 51.6 million tons at 1% lithium oxide. All-in sustaining cost is $1.101 per ton, lowest quartile globally. These are not exploration stories. These are construction-ready or restart-ready assets being positioned now, while lithium is still in a trough. That is a deliberate bet on timing. And the logic behind it is either prescient or premature, depending on one factor that almost no coverage has focused on. The consensus framing on lithium right now is supply glut plus weak demand equals stay away. That framing is correct on the surface. China's lithium carbonate supply was estimated at 88,300 tons in February, down 8.2% from January. Lithium iron phosphate production fell 5.48% month on month. The surplus narrative has data behind it. But here is what gets missed. Supply contractions at the production level are typically a lagging acknowledgement of price pain that already happened. Producers do not cut output the moment prices fall. They cut when cash flows become untenable. The February numbers showing supply decline suggest that the market's self-correction mechanism has already been triggered, quietly, without a headline. The further detail worth examining is the cost structure of new entrants. Manna's all-in sustaining cost of $1.101 per ton does not just make it competitive. It means the project remains viable across a wider range of price outcomes than most peers. Projects positioned in the lowest cost quartile globally are not just survivors. They are the assets that attract offtake agreements and financing first when sentiment turns. Core Lithium's restart structure is similarly notable. Funding is not speculative. Glencore is a counterparty. That changes the risk profile in ways that a simple share price move does not fully capture. The market is pricing these as distressed recovery plays. The structural evidence suggests some of them may be something different. Early-stage positioning ahead of a tighter market. The downside path is not difficult to construct. If BYD's February sales decline reflects a structural slowdown in Chinese EV adoption rather than seasonal noise, then battery demand growth stalls. Legacy projects that are still ramping add supply into a market that does not need it. Projects with December 2026 first shipment dates, like Finniss, arrive into a continuing glut. The capital raisings that fund restarts dilute shareholders at trough valuations, and the recovery window keeps shifting. Under that scenario, Pilbara Minerals and Liontown, which are not restarting, but rather managing existing operations through a down cycle, face the additional pressure of watching newer, lower-cost peers absorb the limited offtake demand available. The recovery path requires two things to converge. First, demand from battery storage and EV adoption outside China needs to accelerate meaningfully in the second half of 2026 and into 2027. Second, the supply side needs to remain disciplined, meaning projects without strong balance sheets or committed offtake do not get financed, keeping new tons out of the market. If both conditions hold, the assets that restarted or reached construction-ready status now will be positioned to capture price appreciation at a moment when new supply takes years, not months, to respond. The 3.5-year payback period on Mana only works if prices recover to levels consistent with the DFS assumptions. But the cost structure means it can survive longer at current prices than most alternatives. The leaning here is conditional. The structural case for a tighter market in the 2027 to 2028 window is credible, but the near term remains genuinely uncertain. Projects making construction decisions now are accepting that uncertainty as the price of positioning. Whether that is discipline or desperation depends entirely on whether demand timelines hold. The one-line version: the assets being built into the trough are either the most rational trade in the sector or the most expensive lesson in timing.